Jindal Stainless Q3 performance also came in better than street estimates. The top line, though, was lower as volumes declined 6% sequentially. Nigel caught up with Anurag Mantri, ED CFO of the company. Listen in.
Last time we were anticipating that our export were actually earlier not doing well too much because of the European market, our targeted premium market like Europe and US were not really seeing a much larger demand. But we were expecting that Q4 exports should open up. But however, what have unfolded in last few days in the last quarter of Red Sea and all the situation, and even the European demand not reviving to that extent, we are not seeing a very high uptick in the export volume. So our earlier target for this year export was 15%. I think we will not be able to move beyond 10 to 12% because of all these ocean freights have increased and the export markets are not showing much of the potential right now. However, we will still be able to meet our volumes of 20% increase over FY23 because as you know, we have made our business model so agile, so we can actually switch between export and domestic market very well. So we will we maintain our guidance for 20% volume growth despite being export not contributing in this quarter also.
Okay.
And on EBITDA per ton, 19 to 21,000 were our guidance. Right now, however, seeing the market and since export we are facing a challenge, 21,000 is not likely a scenario, but we will still be able to meet our guidance of 19 to 20,000. I think we should be able to still close the year with 19 to 20,000, so which is within our guided range.
And what about FY25? How's it looking on volumes and EBITDA per ton?
FY25, we are again targeting another 20% volume growth over FY24. So we will continue to keep this volume growth momentum because our new capacities have also come in place, so it's ramping up. On a EBITDA per ton, right now we are keeping the guidance of 19 to 20 again for FY25 also. We are neither increasing nor decreasing because we need to see a lot of geopolitical situation because our EBITDA margins also largely depend on how the export market fare up because we actually do a premium market export, especially US and Europe. Those markets are very critical for us. And if the situation doesn't improve and all these West Asia situation continue to intensify, we will see some pressures on our EBITDA side. So therefore, we are keeping a balanced view of 19 to 20,000.
Okay.
At this point, I think we should be able to have those targets. And as we go ahead in that year, we'll see how we move ahead.
Let's talk about a couple of acquisitions then. The Ravi Run asset is what you'll have picked up, but I understand that it doesn't have, cold rolling capacity as well. So maybe you'll have to invest into that. Give us some clarity on that asset. How much of more money do you have to put in that to get it up and running? And what's the plan out there?
Yeah, so Ravi Run is a good acquisition for us. We acquired it just 96 crore of investment. It has a cold roll capacity, but even our focus initially will be to it has a pipe and tube, which actually provides a natural extension and going deeper into our stainless steel value chain. We eventually plan to have take it to 8 to 10,000 ton of PNT pipe and tube capacity, which should get a both decorative as well as industrial tube market. So right now it has a largely decorative tube facility of 3 to 4,000 ton, which will gradually start in next 6 months. Initial investment, what we are envisaging in next 12 months time is around 75 crore to start these facilities and our focus initially will be mostly on the pipe and tube and both eventually take it to a more state-of-art pipe and tube facility, which actually gives the natural product extension and more deeper into our value chain.
Your debt has come down to 4,800 crores. You had a capex plan that's underway as well. So could you tell us where is this debt number headed? And also, has the cost of borrowing come down? If yes, by how much? I need to give it to you all because you said the promoter pledge will get released and that's happened. So kudos on that front. But give us an update on the debt.
So debt side, you remember we said that FY24 debt, let me give you the linkage. We gave you the capex number of FY24 for almost 3,200 CR. And with that, the closing debt level, which was expected in FY24 was 4,700 CR. Now, anticipated capex of this year has increased because of two reasons. One is that Ravi Run, which we acquired, which has taken almost 96 crore. So that's one increase. And second, our Indonesia investment is going on a fast track. So our next tranche, which was expected in FY25, may get pulled into FY24 of around 225 crore additional capex. So overall, we may have an additional capex of 325 crore as against the 3,200. So expected capex could be now 3,600 crore. However, we are not revising because mostly we will still try to meet this increase also from internal accrual. However, so our closing debt number could increase slightly by 100 crore to 4,800 crore of debt number, what you mentioned about it. So we are on track. We will prepone some of that capex also. On interest rate front, you asked me, I think the blended interest cost for our average tenure, we have increased our average tenure of the loan of close to 5 year plus. So that's one thing which we have done from refinancing on the back of rating and promoters pledge going on. And the current cost is close to 8%, which is very competitive cost. If you see last year, 1 year, the SOFR and has increased by more than 4%, and government securities rate have increased by 1.5%. Still, our rates have not increased to that extent. In fact, we have now converted our debt portfolio more in a more robust manner to increase our average tenure. So there is no immediate repayment liabilities and reducing the current repayment liabilities. So balance sheet has been strengthened and the current debt rate is close to 8%.
Final question then, the imports continue to be a bit of an issue. What would be on your budget wish list?
See, our first wish list with the government is always that at least the domestic players should have a level playing field. I think we are seeing unabated imports from China. In some form, it should be contained. There are also already DGTR recommendations of the CVTs and anti-dumping. I don't know how this can be addressed in the budget. Second is that India is short of stainless steel scrap, which is our key raw material. So the duties should be a zero duty import, which should be allowed on these scrap because it anyway adds up to the circular economy from ESG front. So from that perspective, I think that those should be the critical thing which government should look at it.